Hello, in this video I will demonstrate the accounting and amortization of a bond that has been priced at a discount. In the previous video we computed the price of the bond that had a $500,000 face value and a stated interest rate of 9%. The length to maturity was 4 years and the market rate of interest was 10%. We computed the semi-annual interest payments to be $22,500, which was computed by taking the face amount and multiplying it by half the stated rate. If the bonds are paying 9% annually, then every 6 months or semi-annually they will pay out 4.5%. So every 6 months the company will pay $22,500 in interest to the bondholders. Because the market rate was higher than the stated rate when we priced the bonds, they were priced at a discount. So now when the bonds are issued, the company receives a cash payment from the bondholders of $483,842, right? If that's what the price of the bonds are, that's the amount of cash the company received. The bonds are going to be recorded at their face value of $500,000. So the liability we record is the face value of the bond. But the difference between the amount of cash the company received when they sold the bonds and its face value is the discount on the bond payable. The discount on the bond payable is a contra liability account. So the difference is equal to $16,158. Now initially, those bonds will have a credit to bond payable of $500,000 and a discount, which is a debit balance because it's a contra liability account, of $16,158. This is going to give them a carrying value equal to the price of $483,842. Remember, the carrying value is the bond liability less the discount. So the carrying value on the balance sheet will be $483,842 when the bonds are issued. So we will assume those bonds are issued on January 1st of 2021. Their initial carrying value is equal to the cash payment that the company received. Every 6 months when the interest payment is made, the company will record an interest expense equal to the effective rate of interest, which is going to be at a semi-annual rate of 5%, market rate divided by 2, and we're going to gradually decrease the discount so that gradually we are increasing the carrying value of the bond. And ultimately, at the end of the 4-year maturity, the carrying value will be $500,000 because the discount has been amortized down to 0. Whenever we have a bond priced at a discount, the effective interest expense that is reported on the income statement will always be higher than the cash payment. Remember, the cash payment is based on the stated amount of 4.5% semi-annually. The effective interest expense that's reported is the semi-annual amount of the market rate of interest, which is higher. So we have an initial carrying value of $483,842. The first interest payment is made on June 30th of 2021. The interest payment is the same amount every 6 months, $22,500. That is what they are contracted to pay out, 9% annually, 4.5% every 6 months. The effective interest expense that will be reported is going to be the carrying value multiplied by the effective semi-annual rate of interest. It is the same semi-annual rate we use to price the bond. So the effective interest expense is going to be equal to the carrying amount times 5%, or $24,192. The decrease in the discount is the difference between the cash payment and the effective rate of interest. So our decrease is $1,692. This is going to increase the carrying value of the bond, because if we're decreasing a contra liability account that subtracts from the maturity amount, the carrying value is going to be gradually increased. So our new carrying value after the first interest payment is going to be $483,842 plus $1,692. The new carrying value is now $485,534. To record that first payment on June 30th, the company records an interest expense equal to the computed effective rate of interest. The discount on the bond will be credited. We are gradually reducing that discount. So it currently has a debit balance. So in order to reduce the bond, reduce the discount on the bond, we credit it. And then the cash payment to the bondholders is $22,500. So this amortization table is going to give us all the amounts we need for every interest payment during the life of the bond. The discount changes, it will be decreasing, but we never change the face value of the bond. So we have $1,692 decreasing the bond, decreasing the discount on the bond. The new discount balance is now $14,466. So after the June 30th interest payment, our new carrying value is $485,534, which is what we computed on the amortization table. So it's very convenient to complete an amortization table when the bonds are issued so that we have all of our journal entry amounts already calculated. So I'm just going to, the cash payment never changes, right? That is going to be equal to $22,500 every 6 months. The effective interest is always going to be the carrying value of the bond times the semi-annual effective rate, which in this problem is 5%. So I can just copy and paste this formula down, which right now we don't see it. The difference between the effective rate of interest and the cash payment is the decrease in the discount. So we can compute that down, and the carrying value changes by the amount of the discount. Okay, so now that we have all our formulas in, the table populates. Let's look at the next interest payment and just confirm what we did back on the June payment. The cash payment never changes because that's the contracted amount the company is paying the bondholders. The effective interest expense is the carrying value of the bond, right? 485, there's E19, you see that there, 485, 534 times 5%, which is half the market rate. And the discount amortization is the difference between the effective interest and the cash payment. We add that discount amortization to the previous carrying value to get the new carrying value. So by the end of the 4-year period, the carrying value is now equal to the face value of the bond. And if we add up all of the decreases that were made to the discount, we see it equals $16,158. So over the 4 years, over those 8 periods, we have decreased the discount by $16,158. So now its balance is 0 at the end of the 4-year period. Just to complete this entry, the June 31st, 2021 interest payment, we have interest expense that will be reported on the income statement of $24,277. The discount will be credited just because of the Excel columns. I can't indent it, so you get it though. We'll move it over to a credit column. The discount amortization is $1,077, and the cash payment, which never changes, I can't stress that enough, is equal to $22,500. So we have, at the end of the year, the bond face value is still $500,000. That's never going to change until the bond gets repaid. We have a discount equal to, well, before we do that, let's complete our June 30th, December 31st journal entry. We're going to decrease the discount by $1,777, and our new balance then is the previous balance minus the decrease to the discount. So now our discount is at $12,689. So the discount, you see the balance decreasing. As the balance decreases, the carrying value increases because we're subtracting less from the carrying value with every period. Okay? So every 6 months, we have the 3 amounts that we need for the interest payment entries. Let's fast forward to December 31st, 2024. The company records the last interest payment on December 31st. Okay, debit interest expense. We have the amount right here in the table. The discount on the bond payable will be credited. We have that amount right here. And we know our cash payment never changes in amounts. Okay, so the company records its final interest payment. The discount now is completely been amortized down to 0. All we have left is the bond payable amount, face amount. It's the date of the maturity. The bond holders are now paid the face value. So even though they only paid $483,842 for the bonds, at the end of the bond's life, they are paid the face value. So they got all these interest payments at 9% annually, 4.5% semi-annually. But then they get this larger payment, an amount higher than what they paid for the bonds. In essence, that's the additional interest to earn them the 10% annually. The company, though, because according to GAAP, we have to match expenses to the time period, we have taken this future interest amount that was going to be paid and allocated it over the repayment period or the payment period of the interest. Okay, so now at maturity, the bond payable is debited $500,000 and the cash payment goes out to the bondholders of $500,000. The discount doesn't need to be debited or credited because it's already at zero. This last entry brought the balance down to zero. There's no balance left. So that's a bond priced at a discount. The effective interest expense that the company incurs over the life of the bond is higher than the cash payments that they make out semi-annually. It's a higher effective interest rate than the stated rate of the bond.